There's a moment in politics when a politician says something with such confidence, such absolute certainty, and then reality comes along and makes a liar out of them. For years, Australian investors were told negative gearing, capital gains tax, these are untouchable, and many of us believed it. We built our financial lives around it. And then, just like that, on budget night 2026, Treasurer Jim Chalmers walked to that podium and everything changed. I want you to understand something before we dive in. This isn't just another budget. I've been watching Australian budgets for a long time, and I can tell you, hand on heart, this one feels different. This is one of the most significant tax shakeups for investors that we have seen in decades. Changes to capital gains tax, changes to negative gearing, and a complete overhaul of how family trusts are taxed. Whether you love it or hate it, and trust me, people have very strong feelings about this. What matters right now is what it actually means for you. Let's start with capital gains tax, because this is where most investors' hearts stopped for a second. For years, decades, actually, the rules were simple and, let's be honest, pretty generous. Hold an investment for more than 12 months, sell it for a profit, and only half of that gain was taxable. That's the 50% CGT general discount, introduced by the Howard government back in 1999. And it has been the quiet engine behind long-term investing in Australia ever since. Property, shares, business assets, all of it benefited from this one beautiful rule. Now here's a small but important relief, and I want you to hold on to this. Any gains you've already accrued before the 1st of July, 2027 are proposed to remain under the current system. So, if you're sitting on a property or a share portfolio right now, the clock hasn't reset on you yet. That is genuinely good news. You have time. But from that date forward, from July 2027, the rules of the game shift fundamentally, and the shift is bigger than most people expected. Instead of that automatic 50% discount, the government wants to move back to an inflation indexation approach. Now, that sounds technical, but the idea is actually straightforward. The government will no longer tax you on the portion of your gain that was simply caused by inflation. Which sounds fair, in theory, but here's the twist that caught me off guard. The budget also proposes a minimum 30% tax on capital gains, no matter what. So even after they strip out inflation, they still want their 30% slice. That part I genuinely wasn't expecting, and it changes the maths significantly. But there is a silver lining buried in those budget papers, and it's a significant one if you know where to look. New property builds get special treatment. Investors who put their money into new construction will be able to choose between the existing 50% CGT discount or the new inflation indexation method. That's a real incentive. The government is essentially saying, we want you to build new homes, not buy old ones. And honestly, from a pure numbers perspective, if you're planning to invest in property after 2027, the case for going new rather than established has never been stronger. Here's the painful irony of this whole CGT change, and it's something that doesn't get talked about enough. These reforms are supposedly designed to help young Australians get into property, and maybe at the margins, they will. But the people who are going to feel the CGT changes most acutely? Young investors. The ones with 30, 40 years of compounding ahead of them, because that's exactly where these changes bite hardest. The longer you hold, the more inflation compounds, the more a minimum 30% tax floor starts to eat into your real returns. The very people this was meant to help may end up paying the highest price. Now we get to the big one, the one that has been debated, defended, demonized, and ultimately, until now, survived every political cycle. Negative gearing. For decades, this was the cornerstone of Australian property investment. The basic deal was this: if your investment property cost you more than it earned, if it ran at a loss, you could use that loss to reduce your overall tax bill. You'd take a hit today, sure, but you'd make it back through capital growth tomorrow. And with the 50% CGT discount waiting at the end, the whole equation worked beautifully. But that equation, that beautiful, reliable equation, has now changed dramatically. Under the new proposal, negative gearing in its traditional form will only fully apply to new builds from the 1st of July, 2027. Properties already held before budget night? They're grandfathered, the old rules stick for those. But if you go out and purchase an established property from tonight onwards, and it runs at a loss, you can no longer offset those losses against your wages or personal income. Those losses get locked in, carried forward, and only used against future rental income or future capital gains from that specific property. The rules have fundamentally changed. What does this actually mean in practice? It means a massive behavioral shift for Australian property investors. For a generation, the strategy was simple. Buy established, take the tax deduction, ride the growth wave. That playbook is being retired. From here, investors are going to need to think much harder about cash flow and yield, not just capital growth. If a property doesn't stand on its own feet financially, it's no longer subsidized by the tax system the way it once was. And that shift, that move away from speculative demand for existing homes, is clearly exactly what the government was aiming for. Now here's where things get really interesting, because not everyone loses from this budget. If I were a property developer right now, I would be feeling very good indeed. Between the CGT concessions for new builds and negative gearing being preserved exclusively for new construction, the government has essentially pointed a giant arrow at development projects and said, "Go here." Demand for new builds is set to surge. Land, construction, development approvals, all of that is suddenly looking a lot more valuable. The developer class is going to emerge from this budget in a considerably stronger position. But here's the problem, and it's a real one. Australia already has a housing supply crisis. We don't have enough homes, and we don't have enough people to build them. The construction industry is stretched, trades are in short supply, and costs are already elevated. So when you dramatically increase demand for new builds without addressing the supply side of the equation, what do you get? Higher construction costs, longer wait times, a building sector under even more pressure than it already is. The government wants more houses built. Wanting it and actually achieving it are two very different things. There is one important carve-out I want to make sure you don't miss, because it's flying under the radar a little. These negative gearing changes only apply to residential property. Commercial property, shares, and other investment assets, they remain under the existing negative gearing framework. So strategies like debt recycling, which have been incredibly effective for many Australian investors, are still very much on the table. If you've been building a share portfolio using debt, or you hold commercial real estate, nothing changes for you under this proposal. That's a meaningful distinction. Now let's talk about something that is genuinely flying under the radar, and for many Australian families and business owners, this might actually be the most impactful change of the lot. Family trusts. For decades, the discretionary trust has been one of the most powerful tools in the Australian tax planning toolkit. The way it worked was elegant income flowed through the trust and was distributed to family members at their individual marginal tax rates. Lower-income family members, maybe a student child, a retired parent, would receive distributions and pay tax at their lower rates. It was flexible, efficient, and entirely legal. Under the new proposal, from the 1st of July, 2028, discretionary trusts will face a minimum 30% tax on trust income, paid up front by the trustee. Beneficiaries still declare the income personally, and they receive a tax credit for what the trust has already paid. Now, if that sounds familiar, it's because it works a bit like a franking credit. But here's the critical difference that changes everything for retirees and low-income beneficiaries. These credits are non-refundable. If your marginal tax rate is below 30%, you don't get a refund of the excess. That money is gone. For families who structured their affairs specifically to take advantage of lower tax brackets, this is a genuine blow. And then there's the bucket company change, which I genuinely didn't see coming. If a discretionary trust distributes income to a corporate beneficiary, what's commonly called a bucket company, that company generally won't receive credits for the tax the trust has already paid. This is a very deliberate move. The bucket company strategy has been extremely effective for business owners and high-income families for years, allowing income to be taxed at the company rate and then controlled for distribution later. The government has clearly decided that this particular strategy has run its course. So where does all of this leave us? Ironically, and I find this genuinely fascinating, one of the biggest winners from this budget might be the plain old company structure. Historically, companies weren't the preferred vehicle for long-term investment because they didn't receive the 50% CGT discount. But if that discount is being reduced across the board for individuals and trusts anyway, that disadvantage narrows considerably. Combine that with the corporate tax rate, dividend imputation through franking credits, and the ability to control when you pay yourself, and suddenly, the company structure looks much more interesting for long-term wealth building than it has in a very long time. I want to be honest with you about what comes next, because it matters. We are entering a period where the conversation around how Australians hold and structure their investments is going to change significantly. Investment bonds, corporate structures for long-term assets, tax deferral strategies. These are the things that are going to dominate the conversation moving forward. The old playbook, borrow, negatively gear, hold, sell with the CGT discount, that playbook is being rewritten. And the investors who adapt early, who get ahead of these changes, are the ones who will be best positioned when July 2027 rolls around. To be fair, and I think it's important to be fair here, it's not all bad news from this budget. There's a $250 tax offset for workers. a $1,000 instant tax deduction for work-related expenses without needing to show receipts, which is actually quite practical for a lot of people. The $20,000 instant asset write-off for small businesses has been made permanent, which is genuinely good news for the small business community. And there were no new superannuation changes, which, given how often they tinker with super, is almost a relief in itself. These are real benefits, but for many investors and business owners, they feel a little like a consolation prize after everything else. Look, budgets always feel overwhelming in the immediate aftermath. There's a lot of noise, a lot of opinion, and genuinely a lot of complexity to work through. What I want you to take away from this is simple. These changes are real, they are significant, and they will affect the way Australians invest for years to come. The details still need to be legislated. There are technical elements yet to be released, but the direction of travel is clear. So, now is the time to sit down with a good accountant, review your structures, understand your exposure, and make sure your strategy is built for the rules as they're going to be, not as they used to be. I'll see you in the next one.